My dear students, welcome back to our channel. Students, in this video I am explaining MBA third semester. Subject Banking and Insurance, second unit. Important short and long questions and answers. Let's start quick revision. First important short question is: what do you mean by bank credit? Bank credit refers to the funds a bank makes available to individuals, businesses, or governments, typically in the form of loans or lines of credit. It allows borrowers to access money with the promise of repayment over time, often with interest. Bank credit plays a crucial role in the economy by facilitating investment, consumption, and growth. It can include various products such as personal loans, mortgages, credit cards, or business financing. Banks assess the creditworthiness of borrowers before extending credit to ensure the risk of default is manageable. Next important short question is: define the term NPA. NPA stands for non-performing asset, which refers to loans or advances given by a bank or financial institution that have stopped earning interest or principal. Repayments. Typically, a loan becomes an NPA when payments are overdue for 90 days or more. NPAs are a significant concern for banks as they indicate the inability of borrowers to repay, leading to financial losses. High levels of NPAs can impact a bank's profitability and stability. Managing and reducing NPAs is crucial for maintaining a healthy financial system and ensuring smooth credit flow in the economy. Next important short question is: what is priority sector lending? Priority sector lending, PSL, refers to the practice of banks lending a certain percentage of their total credit to sectors deemed essential for economic development but often underserved. These sectors include agriculture, micro, small and medium enterprises, MSMEs, education, housing, and export credit. PSL aims to promote inclusive growth by ensuring that disadvantaged or underfunded sectors have access to credit. Central banks or financial authorities often set mandatory targets for banks to allocate a specific portion of their lending to these priority sectors, helping drive economic development and social welfare. First important long question is: explain the different types of accounts in detail. There are several types of bank accounts designed to meet different financial needs. Here are the most common ones. 1. Savings account. A savings account is a basic deposit account offered by banks that allows individuals to deposit money and earn interest over time. These accounts are ideal for individuals who wish to save money while having easy access to their funds. Interest rates on savings accounts are generally lower than other types of accounts, but they provide liquidity and security. They also come with withdrawal limits and may require a minimum balance. 2. Current account. Current accounts are primarily for businesses or individuals who require frequent transactions. These accounts offer unlimited withdrawals and deposits and are not intended for saving money, as they generally don't offer interest or offer very low rates. Current accounts often come with a checkbook and ATM debit cards. They are ideal for daily operations and managing cash flows, especially for businesses. Many current accounts also offer overdraft facilities. 3. Fixed deposit account. A fixed deposit (FD) account is a type of account where individuals can deposit a lump sum amount for a fixed tenure, earning a higher interest rate compared to a savings account. The deposit cannot be withdrawn before the maturity date without incurring a penalty. FD accounts are a low-risk option for those looking to grow their savings over time. The interest is paid periodically or at maturity, depending on the terms. 4. Recurring deposit account. A recurring deposit (RD) account is similar to a fixed deposit, but instead of a lump sum deposit, it allows individuals to invest a fixed amount regularly, monthly. The interest rate is typically higher than a savings account but lower than a fixed deposit. RDs encourage disciplined saving and are suitable for individuals who can commit to saving a fixed amount regularly. 5. NRI accounts, non-resident Indian accounts. These accounts are designed for Indian citizens living abroad. There are various types, such as non-resident external (NRE), non-resident ordinary (NRO), and foreign currency non-resident (FCNR) accounts. NRE accounts allow repatriation of funds, whereas NRO accounts are for managing income earned in India. FCNR accounts help individuals save in foreign currency. 6. Demat account. A demat, dematerialized account is used to hold and trade securities like stocks and bonds in electronic form. It simplifies the process of buying and selling shares without physical certificates, providing quicker and safer transactions. Each type of account serves a unique purpose, allowing individuals and businesses to manage their finances based on their needs and goals. Next important long question is: discuss the procedure for assessment of credit worthiness of a prospective borrower. The assessment of credit worthiness is a crucial process for banks and financial institutions to determine whether a prospective borrower is likely to repay a loan. This procedure involves evaluating the borrower's financial stability, history, and repayment capacity. Here's a detailed look at the steps involved. 1. Credit score evaluation. The first step in assessing creditworthiness is reviewing the borrower's credit score. A credit score is a numerical representation of the borrower's credit history, including past loan repayments, credit card usage, and any defaults. A high credit score typically indicates a low-risk borrower, while a lower score suggests higher risk. 2. Income and employment verification. Lenders evaluate the borrower's income level to ensure they have sufficient funds to repay the loan. This includes verifying the borrower's employment status, income consistency, and sources of income. For self-employed individuals, financial statements and business performance are scrutinized. 3. Debt-to-income ratio, DTI. The debt-to-income ratio compares the borrower's existing debt obligations to their income. A high DTI indicates that the borrower may struggle to handle additional debt, making them a riskier candidate for credit. Financial institutions typically prefer borrowers with a lower DTI, indicating they can manage new debt comfortably. 4. Collateral and security. For secured loans, example, mortgages or auto loans, the borrower's assets, such as property, vehicles, or other valuable items, are assessed as collateral. The value of the collateral serves as security for the loan in case of default. The more valuable the collateral, the lower the risk for the lender. 5. Past credit history. a detailed review of the borrower's past credit behavior is crucial. This includes checking for any past defaults, bankruptcies, or late payments. Lenders will also look at whether the borrower has a history of handling credit responsibly, such as timely repayment of loans. 6. Purpose of loan. The lender will evaluate the reason for the loan. Loans for productive purposes, like business expansion or education, are viewed more favorably than loans for discretionary expenses, as the former suggests the potential for generating income. 7. Economic conditions and industry risk. Lenders also assess external factors such as the broader economic environment and industry-specific risks. For businesses, the stability and growth potential of the industry are considered. By analyzing these factors, financial institutions can determine the risk involved in lending to a prospective borrower. Based on the assessment, they decide whether to approve or reject the loan application and what interest rate to offer. Next important long question is: explain the causes of NPA. Non-performing assets, NPAs, are loans or advances that have stopped generating income for banks, either because the borrower has defaulted on repayments or the loan is overdue. The causes of NPAs are multifaceted, and understanding these causes helps in managing and preventing their rise. Below are the primary causes of NPAs. 1. Poor credit appraisal. One of the main causes of NPAs is inadequate assessment of the borrower's creditworthiness during the loan approval process. If banks fail to evaluate the borrower's ability to repay or overlook red flags in their financial situation, loans may be approved for individuals or businesses that cannot repay, leading to defaults. 2. Economic slowdown. A downturn in the economy can negatively impact businesses and individuals' incomes, making it harder for them to repay loans. Economic challenges, such as inflation, recession, or sectoral declines, especially in industries like manufacturing or agriculture, can lead to defaults, resulting in NPAs. 3. Mismanagement of borrowed funds. Borrowers, particularly in the case of businesses, may mismanage the funds borrowed. This can happen due to poor business decisions, excessive spending, or inadequate financial planning, leading to cash flow issues and an inability to meet debt obligations. 4. Natural calamities and external shocks. Natural disasters, such as floods, droughts, earthquakes, or unexpected political upheavals, can severely disrupt businesses, particularly in agriculture and infrastructure sectors. Such shocks often result in the borrower's inability to repay loans, causing an increase in NPAs. 5. Over-leveraging and excessive borrowing. Borrowers who take on too much debt relative to their financial capacity may struggle to manage their repayments. Over-leveraging is especially common among businesses that expand too quickly or individuals who take out multiple loans without assessing their ability to repay. 6. Delayed or ineffective recovery measures. Banks may delay the process of recovering outstanding loans, often due to cumbersome legal processes or insufficient follow-up on defaulters. The longer a loan remains in default, the more it becomes classified as an NPA. 7. Weak management and corporate governance. Poor corporate governance practices and weak management can lead to financial mismanagement, fraudulent activities, and poor decision-making, all of which can contribute to an increase in NPAs, especially in large corporate loans. 8. Changes in government policy. Shifts in government policies related to taxation, regulations, or subsidies can also have a significant impact on borrowers' ability to repay loans. For instance, sudden regulatory changes can disrupt business operations and cash flow, resulting in defaults. In conclusion, the causes of NPAs are varied and complex, ranging from internal factors like poor management to external factors like economic conditions or natural disasters. Proper credit risk management, regular monitoring, and prompt action can help reduce the occurrence of NPAs. Next important long question is: explain the implications of NPAs. Non-performing assets, NPAs, have significant implications for banks, borrowers, and the broader economy. When loans default and become NPAs, they create a ripple effect impacting multiple areas. Below are the key implications. 1. Reduced profitability for banks. NPAs result in a loss of interest income for banks since defaulted loans no longer generate revenue. The cost of provisioning for bad debts further impacts a bank's profitability. High levels of NPAs can erode the bank's financial health, leading to lower capital adequacy ratios, which are vital for absorbing losses and sustaining business operations. 2. Increased risk and lending costs. The presence of high NPAs increases the perceived risk for lenders. Banks, in an effort to mitigate this risk, may raise interest rates for borrowers, making loans more expensive. This can deter potential borrowers and further slow economic growth. It may also lead to more stringent lending criteria, limiting access to credit for creditworthy individuals and businesses. 3. Impact on bank liquidity. As NPAs increase, banks may find themselves with less liquidity to lend to other borrowers. A reduction in available funds can hinder the bank's ability to fund new loans, impeding business growth and overall economic activity. In extreme cases, high NPAs can even lead to a liquidity crisis for the bank. 4. Economic growth and employment. An increase in NPAs limits the credit flow to productive sectors of the economy. With less funding available, businesses may struggle to expand, innovate, or create jobs. This can lead to a slowdown in economic growth and higher unemployment levels, especially in sectors that rely heavily on bank credit, such as small businesses, agriculture, and infrastructure. 5. Decreased investor confidence. A high level of NPAs signals financial instability in the banking sector, which can undermine investor confidence. Investors, both domestic and foreign, may be hesitant to inject capital into banks or the economy, fearing a riskier financial environment. This can result in a decline in stock prices and a reduction in foreign investments. 6. Pressure on the banking system. A large number of NPAs can put significant pressure on the entire banking system, requiring intervention from regulators or the government. To stabilize the system, banks may require capital infusion or other forms of financial support, leading to a strain on public finances. 7. Impact on borrowers. For borrowers, an inability to repay loans results in legal action, property confiscation, or bankruptcy proceedings. In extreme cases, It can ruin the credit history of the borrower, making it harder to access future credit and increasing the likelihood of financial hardship. In conclusion, NPAs have far-reaching consequences that extend beyond individual borrowers, affecting the stability of the financial system, economic growth, and investor confidence. Effective management and reduction of NPAs are essential to ensuring a healthy, stable economy and a functioning banking sector. Next important long question is: explain the recovery of NPAs. The recovery of non-performing assets, NPAs, is a critical process for banks to minimize losses and improve their financial health. Effective recovery strategies can help banks recover some or all of the outstanding loan amounts from defaulted borrowers. Below are key methods used for NPA recovery. 1. Restructuring and rescheduling of loans. In some cases, banks may offer to restructure or reschedule loans to provide the borrower with more time to repay. This can include extending the loan tenure, reducing the interest rate, or temporarily lowering repayment amounts. Restructuring is typically considered for borrowers who are facing temporary financial distress but show the potential to recover. 2. One-time settlement, OTS. A one-time settlement involves negotiating with the borrower to settle the outstanding debt for a lump sum amount that is typically lower than the total dues. This option is often offered when recovery through regular loan repayments seems unlikely. OTS can help the bank recover part of the debt while providing relief to the borrower, avoiding lengthy litigation. 3. Legal action and recovery. If other methods fail, banks may resort to legal actions for recovery. This includes filing lawsuits or seeking orders from debt recovery tribunals, DRTs, to recover dues. The bank can also take possession of the borrower's collateral through the legal process. In case of secured loans, banks may auction off the assets pledged as collateral to recover the outstanding amount. 4. Asset reconstruction companies, ARCs. Banks can also sell NPAs to asset reconstruction companies, ARCs, which specialize in managing and recovering distressed assets. ARCs purchase NPAs at a discounted price and attempt to recover the dues through various measures. They may restructure the loans, sell collateral, or take legal action to maximize recovery. 5. Out-of-court settlements. In certain cases, banks and borrowers may opt for an out-of-court settlement. This could involve renegotiating terms or agreeing to a new repayment schedule that works for both parties. This method is faster and less costly than formal legal proceedings. 6. Debt recovery tribunals, DRTs, and SURFACE Act. The debt recovery tribunals, DRTs, are set up to handle the recovery of loans and NPAs under the SURFACE, Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act. Banks have the authority to take possession of a borrower's assets and sell them without a court order. This gives banks a faster and more efficient recovery mechanism for secured loans. 7. Corporate debt restructuring, CDR. For large corporate borrowers, a more complex recovery strategy is corporate debt restructuring, CDR. It involves a formal process where creditors come together to modify the terms of the loan, such as extending the repayment period or adjusting interest rates to help the business return to financial health. In conclusion, The recovery of NPAs requires a combination of strategies, including loan restructuring, legal actions, and the involvement of ARCs. While recovery processes can be lengthy and complex, timely and effective, management of NPAs can help reduce the overall impact on the bank's financial stability and ensure better utilization of resources. As the interest rates are expected to change, ABC Bank wants to change floating rate of interest to its borrower. The present prime rate is 8% PA. The bank wants to charge a premium of 350 basis points over the prime rate for this borrower. You are required to find the floating rate for the borrower as per prime plus and prime time rate methods, and which of the two methods would be beneficial to the bank. Further, if the prime rate increases to 9% and or decreases to 7.5%, what would be the floating rate for the borrower? To calculate the floating rate of interest for the borrower under both the prime plus method and prime time rate method, let's break down the steps and calculations. 1. Prime plus method. The floating rate is calculated by adding a premium or spread to the prime rate. Prime rate is equal to 8% PA, current rate. Premium is equal to 350 basis points is equal to 3.50%. 1 basis point is equal to 0.01%. So, using the prime plus method, the floating rate for the borrower would be floating rate is equal to prime rate plus premium is equal to 8% plus 3.50% equals 11.50%. 2. Prime time rate method. In the prime time rate method, the floating rate is typically calculated by multiplying the prime rate by a factor or adding a fixed premium. Assuming the bank uses the same premium, 350 basis points or 3.50% as a fixed amount, the method would be similar to the prime plus method, where you just add the premium. However, if the prime time rate method implies a more complex multiplication formula, such as the prime rate asterisk a fixed multiplier, we would need additional details on the exact formula to calculate it. For simplicity, we assume the prime time rate method also uses the same premium here, yielding floating rate is equal to prime rate plus premium is equal to 8% plus 3.50% equals 11.50%. Which method is beneficial for the bank? Both methods, prime plus and prime time rate, appear to lead to the same floating rate of 11.50% when using a 350 basis points premium in the example. However, typically, prime plus method is simpler and more predictable as it directly adds a fixed premium to the prime rate. Prime time rate method, depending on the formula used, if it involves a multiplier, could be more flexible and responsive to changes in the prime rate. For ABC Bank, the prime plus method would generally be easier to implement and understand, while the prime time rate method might offer more flexibility if the prime rate fluctuates or if a different calculation structure is required. Floating rates if prime rate changes. 1. If the prime rate increases to 9%. Prime plus method. Floating rate is equal to 9% plus 3.50% is equal to 12.50. Prime time rate method. Floating rate is equal to 9% plus 3.50% is equal to 12.50%. 2. If the prime rate decreases to 7.5%. Prime plus method. Floating rate is equal to 7.5% plus 3.50% is equal to 11.00. Prime time rate method. Floating rate is equal to 7.5% plus 3.50% is equal to 11.00%. Conclusion. Floating rate under current prime rate, 8%, 11.50% for both. Methods. If the prime rate rises to 9%, the floating rate will increase to 12.50%. If the prime rate falls to 7.5%, the floating rate will decrease to 11.00%. For ABC Bank, the prime plus method provides a straightforward approach. While both methods yield the same floating rate in this case, the bank would benefit from either method, but the prime plus method is typically more commonly used due to its simplicity. A customer wants to borrow 50 rupees CRS from XYZ Bank. The bank studied the risk associated with the borrow and found that the probability of repaying the principal and interest is 94% as per schedule. In case of difficulty, the bank loan recover 81% of the principal and interest is 94% as per schedule. In case of difficulty, the bank loan recover 81% of the principal and interest due. The minimum required rate for the bank is 14%. The cost of funds for the banks is 12% and associated service cost is 0.25%. What rate should the bank quote to the borrower? To determine the rate that the bank should quote to the borrower, we need to calculate the bank's required return, considering the risk of non-repayment and its cost structure. Step 1. Determine the bank's expected loss, risk adjustment. The bank has identified two scenarios. 1. Normal repayment, the probability of full repayment, including principal and interest, is 94%. In this case, the bank recovers 100% of the loan amount and interest. 2. In case of difficulty, the probability of partial repayment is 6% since 94% of repayment is expected. In this case, the bank recovers 81% of the loan amount and interest. Let's calculate the expected loss. Full repayment, 94% probability no loss occurs. The bank gets 100% of the principal plus interest. Partial repayment, 6% probability the bank only recovers 81% of the principal plus interest. To determine the expected recovery, expected recovery is equal to 0.94 times 1 plus 0.06 times 0.81. Expected recovery is equal to 0.94 plus 0.0486 is equal to 0.9886. So, the expected recovery is 98.86% of the loan and interest. Step 2. Bank's required return. The bank has the following costs and minimum required rate. Cost of funds, 12%. This is the cost the bank incurs to borrow money. Service cost, 0.25%. Minimum required return, 14%. The bank's required return on capital. Thus, the total minimum required return the bank needs is required return is equal to cost of funds plus service cost plus minimum required return. Required return is equal to 12% plus 0.25% plus 14% equals 26.25%. Step 3. Adjusting for risk. Since the expected recovery is 98.86%, the bank should adjust the quoted rate to account for the risk of not getting the full amount back. The risk-adjusted rate is given by risk-adjusted rate is equal to required return expected recovery is equal to 26.25%. 0.9886 is equal to 26.54%. Step 4. Final rate to quote. The bank should quote a rate of 26.54% to the borrower to cover the risk of partial repayment, the cost of funds, service costs, and its required return. Students, for other units explanation and other subjects quick revision or explanation links are available in description. Check out once. I think it will be useful to you. Thank you. Thank you for watching. Like and share this video with your friends.